up guys, this is everybody right here. I'm super excited to bring you a new video every brand new week. So in today's video, we're just going to be talking about the risk management that I'll be applying for year 2025, even in many more years to come. So without further ado, let's get down into the first quadrant we have here is you need to know your risk appetite. So what is risk appetite? Risk appetite is the process by which a trader evaluates himself to see the type of trader he or she is, whether he loves his food hot or he loves it cold. So first and foremost, you need to know your risk appetite, whether you are the aggressive type or the conservative types. So if you are the aggressive type, then you follow suit. If you are the conservative type of trader, then you follow suit. What I mean by aggressive trader is that if you are the type of trader that may like to lose maybe 50% or 20% of your account, that is aggressive trader. But if you are a conservative trader, you may like to risk like 1% and 0.5%. And please note again, risk is relative. I might be comfortable losing $10, $20 on my account, thereby you might not be comfortable losing such an amount of money. So first and foremost, you need to know the type of trades, the type of trader that you are, and you just follow suit. So we're talking about the risk appetite too. You don't want to be risking 50% of $1 million. No, that is too high because you might lose all your money and you'll be calling forex as a scam. So risking 50% of your account should be like flipping account, like maybe if you have $50 or $100, even less, that you want to flip, because $100 and $50 are really small in trading in financial market. So you can risk like 50%, 20%, 10%, even as the case may be. So the second aspect here is that you need to use a stop loss order. Now what is stop loss? Stop loss is the order that you give to your broker that when price get to a specific point, the market should cut you, the broker should cut you in specific loss. Like what I mean in essence is that, so what I mean by stop loss order is that, take for instance, you want to sell, let me just look for a scenario here. Or let's assume you said you want to buy at this point. Let me bring my buy functionality. Say for instance you want to buy at this point. So like as I was saying, say for instance you want to buy at this point. Maybe your strategy says you should buy and you put your stop loss here. This is your order. This red side means your stop loss, and this green side means your reward. That is, this red side, this particular red side is your risk and this is your reward. So if you are to set your stop loss now, you now set your stop loss at this point and your take profit will be times 2, even as the case may be. So what I mean is, what the take note from this lesson is that, from this particular explanation, is that you should be able to spot your stop loss points then to avoid unnecessary loss or irregularities from the financial market. Please note, you cannot really control what you can risk, but you cannot control what you can gain, because we can control our risk, we can control our gain. So how to control your risk is by applying the process that I just taught you guys, which is the stop loss order. So the other aspect here is that you need good risk to reward. Talking about risk to reward, say for instance, in every trade, in every business, you want to buy low and sell high. You want to buy when the market is not there, like when the market is not famous, is not popular, and sell when everybody is aware of the market. So say for instance, I bought an iPhone 12 maybe for $500 or $600, even as the case may be. I want to sell it at least maybe $1,000 or $1,200, because From there, I will be factoring my transportation fee and other miscellaneous payments. So risk to reward is very crucial in risk management. So let's come back to this previous example that we did initially. So this red aspect is the risk and this green aspect is the reward. See, the risk to reward here is 1 to 4.26. This is how you can know the risk to reward. We are risking very small amount of money to gain. Let's say for instance I'm risking for $100 to gain at least $400. That's what I mean by 1 to 4 risk to reward. Even if I'm let me see it, or let me bring it to the lower space. I'm risking $10 to make at least $40. So even if I have at least 2 loss, if I win once to clear out my losses, that's what I mean by this risk to reward. So you have, as a trader, you have to target at least minimum of 1 to 2 risk to reward. So with this, you see yourself being profitable in the next 3 to 6 months. So the next aspect here is that you need to determine your daily loss limit, even your weekly loss limit as well. So like as a trader, say for instance I have $1,000 account, so I might just say, okay, this week I want to risk 10% of that $8,000 account, which is 10% of $1,000 account, that is $100. So let me say my weekly loss limit should be like 10%, which is $100. So that 10% of $1,000, which is $100, I will now split it into the 5 trading days. Like if I'm the type of person that trade on Monday, I'll now split that $100, which is my weekly loss limit, into 5 positions, which is $10 per day. So on Monday I'll reach $10, Tuesday $10, Wednesday $10, Thursday $10, Friday $10. So you need to be disciplined to stick to your loss limit. You understand, right? You need to be disciplined to stick to your loss limit. Say for instance, when you lose that $10, your daily loss limit is $10. When you risk it and it doesn't, and it rips off, which is it goes against you, then close for that day. The following day, you risk another $10 again, which is $20. So with that said, you see that like trading is not a get rich quick scheme. You can't come to trading today and be expecting to buy Lamborghini or Jaguar in the next 3 months. So it is a gradual process. Trading is just like a normal, let me say our normal traditional businesses. You can't start business today and expect the business to grow faster in 2 weeks or in 3 weeks. You have to put a lot of hard work before you can see that your trading business goes bigger and bigger. The same thing applicable to forex trading. So with that said, let's go to the next one, which is what? The position sizing calculator. What I mean by position sizing calculator is that in the previous one I talked about the daily loss limit. So I'm gonna teach you how to determine the amount of money you want to risk per trade. So talking about position sizing calculator. So what I do in controlling my risk, please pay close attention, please, because this is the biggest aspect of risk management in forex trading. So what I do use is position size calculator. And this is it. So like as I was saying initially, that maybe if you have $1,000 account, personal funded account to trade, let's say, sorry guys, so this is it. This is the user interface. The account currency is USD and the account balance is $1,000. So the risk percentage, okay, let's say we said the weekly risk percentage is risk limit is 10%. So let's say we use maximum of 15 pips stop loss. If you are a swing trader, this is your risk management. Like if you trade only if you trade only maybe once in a week or twice in a week, let's say 15% as a risk management, then you now press calculate. So look at what I was saying. So 10% of $1,000 is $1,000. So the recommended lot size for you to use is 0.066. Forget the remaining C7. This is the one you are going to use on your MT5. Now with that said, now let's come to our daily loss limit. That is 1%, then 15 pips, and you now press calculate. So the recommended lot size for you to use on your $1,000 account is what? 0.06. This is the recommended lot size for you to use. And if the trade whipsaw against you, you'll be losing $10. So with that said, but you applying this same strategy over and over and again, you see yourself being profitable in 3, 4, 5, 6 months, and even as the case may be. So now let's go to the next one. So the next one here is that you need to limit the number of trades it takes per trade, per week, even per day. I personally, I have 2 tries in a day. If I apply the first try and it doesn't work, I'll go for the second one. The second one doesn't work, then I'll close for that day and wait for the next day. So, and I value quality over quantity. Like, I take quality setups and not quantity setups. Sometimes I might stay like a week, I won't see any setup. Not that I didn't see any setup, but it didn't meet up with my preferences. I personally, I have about 4 checklists, which are psychological level, trend line, high and low of the week, and chart pattern. So if I see 3 out of these 4 checklists, I'll trade. If I see 2, I'm not gonna trade. If I see 1, I will not trade. If I see 4 out of 4 conferences, I'm gonna trade. So you have to value quality over quantity. So the last aspect here is for you to diversify your portfolio. Now, diversifying portfolio means splitting your account into different assets. Like maybe I have $1,000, since you'll be using $1,000 from the onset. For instance, I have $1,000 to invest in the trading market, in the financial market. So I might decide to split it into, like, let me say, I'll split it into like $100, $100, $100 in 10 places to control my risk, to control my losses, and also to maximize my wins. So if you like this type of content, smash the like button, subscribe, share this video to your family and your loved ones. See you on the next one. Thank you guys.